All right, welcome to this presentation on the ultimate hedge strategy. My name is Daryl Martin with ApexInvesting.com, and I appreciate you joining me for this presentation today. This is my favorite strategy in trading that exists, just because of all the advantages it gives you. And I've called it the open box strategy, the ultimate hedge strategy. It's the perfect strategy for people who like to, day trade, or they're trading over maybe a 1 week period. So it really lines up well, gives you maximum risk protection that you can't get with, regular vanilla call and put options that you can get with the spreads over on Nadex. If you haven't watched this video, or if you're just watching this video, if you haven't watched the spreads course that I have, the foundation spreads course, you're going to want to go back and watch that, because otherwise you're going to be completely lost as we dive into things, because I'm going to assume you understand everything on that spreads course that you need to understand, like premium, proximity, risk reward, just basic things like that you should already understand. So make sure you go back and watch that if you haven't watched it yet. And in this segment, we're going to talk about the risk and proximity formula that you need to know, and I'm going to show you a cheat on it as well. And I'm also going to give you an example of the ultimate hedge. And we're just going to, add on different layers, but it's really a simple strategy. So many people make it complex. It doesn't have to be complex. If you get spreads, at least the majority of the stuff about spreads, then this is a really simple strategy for you. The only thing you'll have to work on is, picking the best spread. And that's really not that hard. You just learn to eyeball it. And I'll go through plenty of examples in a separate video as well. And of course, we have Q&A webinars, different things like that we do. But again, this is about risk and proximity. And one of my favorite quotes comes from Bobby Axelrod on the show Billions. If you haven't watched it as a trader, you should definitely watch it. You'll really enjoy it. It's crazy. It's awesome. It's an HBO show, and you can get past seasons and all that, but it's really fantastic. And the quote goes like this: a good trader feels good when they place a trade. A bad trader feels bad when they place a trade. And a great trader feels nothing when they place a trade. And the whole point of that is, it's not that you don't have any feelings, any emotions, that you're just a robot. Of course those emotions can be good and you can embrace them. But the whole point here is your risk should totally be in check. And so you don't have to have that emotion of every tick going for you and against you. Okay? And so we're going to talk about that. I'm going to show you it and just how simple it really is. And so you don't have to have those emotions just going up and down, but you can still have amazing reward potential. So first thing I want to do is let you know the ultimate hedge. You're going to be combining Nadex spreads with Forex or futures. You'll also be able to combine them. We'll talk about how to combine them with Nadex spread contracts. So spreads with spreads. And I'll talk to you about how to combine them with the new touch bracket contracts too. So, there's a lot to it, and we'll be going into it piece by piece. It's really simple to cross from one to the other, and I'll talk about that more in the ratios video. Like I said, I also call it the open box strategy. The reason I call that is because, if you plot a spread, it looks like a box. It's got a start time, it's got an expiration time, it's got a floor, it's got a ceiling, makes a box. And if you just do a spread, you're capped on your reward. And you're also capped on when it expires. But if you do this strategy, you're not capped on your reward using FX and futures. You still have plenty of potential on, touch brackets. And then you also, aren't as limited to your expiration because you got either weekly or, contracts that last a month or 2 months or 3 months. So there's a lot of different ways you can do it. But the big thing is you don't have to be worried about your capped profit, even though it's not really a horrible problem. Again, that's why it's called open box, because it's you're opening up the lid on the profit side. So what can you do it on? Well, you can do it on the S&P, you can do it on the Russell, Small Cap 2000, the NASDAQ, and the Dow. Those are the future symbols for those. You probably know those by now. And you can do it on corn and soybeans as well. So ZC and ZS. You can do it on gold, copper, silver. And you can do it on oil and natural gas. I'm also going to teach you how to do it not just on the USD pairs, but I'm going to teach you how to do it on all the Nadex pairs. And I'm going to show you, and I haven't taught this before, how to do it on FTSE and FDAX. Again, I have not taught that before. I'm going to be teaching you how to do it on the FTSE and the FDAX as well. Okay? And hopefully you'll learn some pieces as we put all these different videos together, and you'll really start to grasp it and how the ultimate hedge strategy works. It's like I said, it's simple, but it can sometimes feel a little bit complex. So one thing that's also to be aware of is currently there's no spreads on the China 50 futures contract. There is only master spreads on the Nikkei, or the Japan 225. And so you can't really do a low risk option with it when there's only master spreads, unless it happens to be at the extreme floors or ceilings, and it trades in really limited hours. So it's not that you can't do it, but it would have to be at a floor or ceiling after a big move, and then you'd have to be looking for a reversal. So it's one of those that really it's not worth diving that deep into because of those facts. There's not currently touch brackets on it. Most people don't have an actual Nikkei 225 account, but maybe on the CME they might have the contracts available there if depending upon your broker. So but again, probably something just to not really worry about. Bitcoin, they only have a master like weekly and monthly spread, and they tick in weird sizes and all that stuff. Not really your ideal for the hedge. Okay, so they're great for if you want to trade those markets, but you're going to be looking at the spreads on the Nikkei and Bitcoin. You'd be looking at like binaries on China 50. So not contracts I trade a whole lot myself. I have traded them in the past, but really just not my big focus. There's plenty of other markets that are worth focusing on. So first, let's talk about the risk formula. Okay? The risk formula is really simple. When you're going long, it's the difference between where you buy the underlying and sell the spread. Okay? So if I buy at 110, whatever it is, 1,010. We'll make it 1,010. Okay? And I sell the spread at 1,005. Okay? Then my risk is $5. Does that make sense? If I buy at 1,010 and sell at 1,005, my risk is $5. It's just where I buy and I sell. That literally is how you figure out the risk. It really goes the other way when you're going short. Differentiating where you sell the underlying and buy the spread. If you sell at 1,005 on the underlying market, you buy at 1,010, your difference is 5. Right? So it's really just the difference where you buy and you sell. That's your risk formula. And like I said, we'll look at plenty of examples. But, think about how much do I make? The difference where I buy and I sell, or sell and I buy. Same thing. How much are you risking? In this case, you're locking it in an instance because you're buying one, selling the other. So the difference between that is your risk. Your risk isn't going to get larger. It's pretty cool. As long as you're within the spread. Just throw that on there. And I'll show you what I mean on that too. Now, proximity, in our case on hedges, is pretty important. Okay? And it's really simple. It's the difference, okay, or the distance from the underlying must move for you to lock in a profit as of expiration. Okay? Now, I'm not talking about the risk and proximity numbers you see on the scanner. I'll talk to you about that in a moment. What I'm letting you know is, what you want to know is how far does the underlying market, let's just say you're actually buying the ES future, okay, where you're selling the pound dollar spot FX. How far does it need to move, okay, for you to lock in a profit? That's as of expiration is the technical detail, okay? And a simple way to know this, okay, is it's the risk of one spread contract. Because you need to overcome that risk in that spread contract for you to start making money. Because if, let's say, you're losing $1, making $1, okay, making $1 going short on the pound dollar, but losing $1 being long on the pound dollar spread, you need to make that $10 back so that way you can start becoming profitable. And we'll get into examples. And, just basically you have to cover the spread risk to be profitable. You don't have to hold to expiration, okay? Because that's another question that can come up. No, you do not. You can hop out. Sometimes you can hop out in less time than the proximity. But that's sort of the distance I use to calculate to know how far do I expect this thing to move before I really start seeing a net P&L go up on a trade. All right? And that's simply what is the risk on the spread. And again, I'll bring that back. I'll show you a trick on the scanner here in just a moment. Now, another thing that people get confused a lot, all right, is they confuse the hedge risk and the spread risk. So they totally get these all mixed up. Your risk on the hedge formula is the difference when you buy like the underlying and sell the spread, or sell the spread and buy the underlying, or whatever. Sell the touch bracket and buy the spread. Sell the master spread and buy a spread. Buy a touch bracket and sell a spread. Buy a forex, spot contract and sell a spread. So, that's your difference when you're selling and buying those. Okay, that is the risk. The difference of those is your risk when you're doing a hedge. When you combine these two things together, it defines your risk. Okay, the risk on a spread. Because remember, you could be long the pound dollar and short the spread. So you could be making and losing a little bit at the same time, right? The risk on a spread is simply the distance the market has to move to be profitable. It's not your actual risk. So you could have a spread with a $50 risk, okay? But you may only have a $10 risk on the trade. Because you bought one and sold the other, $10 away. And I'll show you examples of that too, especially when we get in the example section. But the risk on the spread is the distance the market needs to move for you to be profitable as of expiration. That's just the spread, but you're not just doing the spread. So your risk can actually be lower, could be higher, could be lower, okay? Your risk is the difference between where you sell the spread and buy whatever else it is you're using, like the underlying or touch bracket or FX contract or master spread, or vice versa, okay? And spread risk does not equal hedge risk. So understand, spread risk is your proximity. Okay? Your hedge risk is the difference between where you're selling the underlying or whatever and buying the spread, or buying the underlying and selling the spread. Okay? So it's going to come up. You may be like, what are you talking about? Remember when you start to ask, well, is my risk this? No, on the spread, that is not your risk. Okay? Your spread risk is not necessarily your risk on the trade. So your risk on the trade is the difference between the two. Your spread risk is simply the proximity you have to make for the underlying in order for you to actually begin making money. So let's look at an example. Okay? And let's say you have a spread floor all the way down at 5,700. All right? So we got the spread floor at 5,700, and we actually looked at this similar example right here when we were doing the spreads, and I talked to you about the spreads and how they worked. Okay, and we looked at, going short using a spread to do it. Well, now we're looking at buying a spread and still going short, but this time, like, we're either going short with the pound dollar, or we could be using a future contract, or we could be using a touch bracket, or we could be using a master spread. I'll talk about all those options when we get into the ratios. But right here we got the spread, floor at 5,700, and it goes all the way up to 5,950. Okay? So it goes up 250 pips. Now, why is that important? Is if the market gets up there, you need to be out of your FX contract or your future contract or your whatever contract, because the spread isn't going to hedge you past the ceiling if you're short. Again, the spread won't hedge you past the ceiling if you're short. So if you're going short on pound dollar and the spread is helping hedge you, reduce your risk is another word for hedge, right? It caps out on how much it'll pay out. Think about an insurance policy. We'll pay this much for a car. So, you don't want to be having a $10,000 insurance policy on a $40,000 car, right? So at a certain point, you need to get out. In this case, you need to get out when it goes up. If it goes up, all the way to 250 pips. So, and you may be using a 100 pip wide spread. You may be using a much narrower spread, okay? So you may be using a 70 pip wide spread. But the point is, be aware of that ceiling, because that's where there's just no more coverage. And then on the flip side, if you're buying, right, the floor will be the cap of where it will no longer hedge you. So it goes both directions. All right? So let's say we go in, market's doing this little thing, we got a trend line, whatever, we want to go short. Okay? And so we look at going short at, let's say, where the market is right now. A little bit lower, a little bit higher, actually, than where we were able to go short when we just did a spread. When I showed you the spread example back in the spread foundations course, we were short like 35 ticks below. So we had a $35 risk on the trade. Okay? Because remember, you got that premium in there, and we had to sell it a little bit, down here. But now we're going short actually where the market is at 56.85. Okay? So if we're selling at 56.85, we got to look at, where's the buy? This is an out of the spread contract, right? Because the underline's below the floor. So on this spread contract, we're going to buy it at 57.10. Just has some premium in it. Like I said, it's, a little bit below there. We got to exit if it hits where? The ceiling, 59.50. How much do I got to put up on this? $10. Okay? $10 that I got to put up to buy that spread. And hey, that's great. It's only $10 risk, but it's got to move, all the way up there in order to, like 25 pips to make anything on the trade. Okay? So just remember, it's got to move 25 pips if we were going to buy. Now, I don't have to worry about that because I'm using it as a hedge. So, how do I calculate my risk on this trade? Well, I look at where am I going to sell the pound dollar, 56.85, and where am I going to buy the spread, 57.10. So since I'm selling at 56.85 and buying at 57.10, right? Then my risk is how much? I think 710 minus 685. Okay, is 25. So I'm risking 25 pips on this trade. All right, if I sell at 56.85 and I buy the spread at 57.10, my risk on the whole trade to go short is $25. It'll cover me all the way up because as this contract, let's say as it's losing money, this one will start making money. Okay, after it moves that 25 ticks. Then if I'm short at 57.10 and long at 57.10, well, I'm not going to be making or losing anything on the way up, right? I'm going to be neutral, net between my two accounts there. Okay? And we'll talk about, managing two accounts versus one account and ways to make it easier. But just simple, enter at 56.85, buy at 57.10, my risk is $25. What's my proximity? How far do I need the pound dollar to move down to make money when I bought this spread to hedge my position? Well, it has a $10 risk, 10 tick risk. That's on one contract, is all I need to know. Not my total, but like if I do one, it's 10 pips above the floor, right? So it has $10 there. So I need to move down 10 pips to make money on this trade. That's not bad at all. Like move 10 pips in my favor, and I have a $25 max risk, and I have no cap on my profit, and a 250 pip hedge. Pretty good. Now, if somebody, why don't you just buy the spread? Well, I mean, one, you'd have to be long, okay, but two, it'd have to move, 25 pips up before it really started making anything with that proximity, right? So, I mean, it could make a little bit, but not much on the way. Just like this could make a little bit, but not much until it's past that 10 pips. So, has to move pretty far. Even though the risk may be low, the distance is further for it to be profitable. This one only has to move 10 pips in my favor to be profitable. So it's really good to be able to know, like, okay, like, what's that risk? That's my proximity. What is my, actual risk on the trade? Well, that's simply the difference where I sold 56.85 and bought 57.10. And so market goes up and does that to you, right? And we've all had that happen. And you're not stopped out. It's going against you, but your spread is making money. At 57.10, it started making money. Faster and faster and faster, all the way up. And then it went back in your favor. Pretty nice. So on this trade, if you sold one mini lot, okay, the correct wording there. There we go. One mini lot at 56.85, and I, had a stop all the way up at 59.50. I mean, that's a huge stop. My initial margin, and we're going to talk about why that's really important to understand the difference here in, one of our future videos. So when I go into the tips and all that you need to be aware of. But the initial margin on the trade is $653. So if I sold at 56.85, I bought at 57.10. I have a 25 pip or tick, however you want to call it, risk. My risk is $25 on the trade. No profit cap. Like, market's down here, Remember when we just did the spread example at the beginning, like it expired right there. Okay, so you had to get out with a $96 profit. Not saying that's a bad profit, but maybe you expect it to keep going. Okay, well, you can just trail your stop. You can stay in the trade. You don't have to get out just because it's 3 o'clock or whatever. Okay, by not just using a spread to do your trade, by using like touch brackets or futures or forex or whatever. Now, one thing to take into account is you made $96, but you did lose the $10 on the spread if it expired. Okay, so $86 profit. And again, you could have stayed in longer. You could have trailed the stop. You could have added another spread on to this as well. Okay, but just for the initial example, look at this right here and see how you could have put that spread on. And what's cool is you start getting this down, and then you start realizing, wow, I could buy another spread and lock in like $96 of my profit, but get back like, say, potential 25, and instead of using a trailing stop, I could use another spread. And that way I've protected my profit, but I still can really let it run without having to worry about getting stopped out. You can just buy another spread. Buy another spread. It keeps moving in your favor. So, it's really cool as you start using them, and as you master just the basic spread, then you could literally put like another spread right here. Like, let me just draw a picture for you. Okay. So you went in, you did this trade, and let's say it got down here, and let's just say that spread expired, and you wanted to put on another spread contract. Okay. So you could buy, even if, let's just say it's a smaller one. Okay. Like right here. So you go in and you buy this one, let's say right here, and you're still short down here. So you got that risk. Okay? But it's like putting a stop right there. Because this thing will hedge you from the price you bought all the way up to the ceiling. So you could literally buy another spread and that spread expires. Or you could buy another spread along the way. Maybe you don't wait till it expires. Maybe you decide, when it got down to here, you got nervous, and you put another one on to protect some of your profits. You sold here, and you're still short there, I guess, right? Because you sold back here. And then let's say you bought right here. So now you're risking up to that much of your profit that you've made. But now if it goes way up, you don't have to worry about it. And if it goes down, you can continue profiting. So you can really start adding these hedges in, not only just as initial hedges, but they could be used after, maybe a certain price movement has been made. You don't have to wait till, you could put it on right when the trade starts. Or you could wait for the trade to go in your favor some. Maybe you don't like the hedges that are available, but later one becomes available as it moves down. And so you find a good hedge that you can add on to start protecting your profit. Or you could just add on another hedge to, it's a little bit of insurance, right? You're paying a little bit, like maybe another $10 out of your last, say, 40 pips you made. But now you have that, hedge there to protect more of your profits. You don't have to deal with getting stopped out on a trade. So this is really a cool way to trade. And, it allows for you to have a lot of options, which is the whole point of trading options, right? And, one thing I wanted to point out to you is it's not just right here. We can also expand this, and we can do 10 contracts. So we go through the exact same thing, but again, we're not going to sell down here on the spread. We're going to sell higher because we get to sell where the FX pair is. So again, I sell at 56.85. I buy at 57.10, but this time I'm going to sell 10 mini lots. I'm going to buy 10 spreads. So it goes up, it comes down, put up your margin, all that fun stuff, make $960 on the trade. And if you want to lower margin a lot, again, go back and watch the touch bracket contracts because you can use those. And we'll talk about how to, hedge with touch brackets as well. But, the math works the same, okay? As far as what's your proximity, what's your risk on the trade, things like that. So there'll be a couple extra factors we'll add in on touch brackets, but as far as everything I'm going over in this video, it all really comes out to the same thing, except for knowing where that touch level is. So on this one, doing 10 contracts, risk 250, made 960, lost $100 on the spread, so netted $860, but not a bad risk reward analysis. 3, almost 4 to 1, and then if we look at this as well, we can go in and think about, quite a few different things. But one of the things I want you to point out is, the risk here is $100, right? but it's only $10 for one contract. It says you don't have to move 100 pips to get to break even. I mean, you're in 10 short. A full lot is 10 mini lots. You bought 10 long. So what is risk on one contract? 10. So it only needs to move 10 for you to be, really to start making money, called break even at that point. And, again, you can stay in this. You can add on more hedges, things like that. And then one thing to really think about right here, let's say it comes down, and let's say at 56.40 for whatever reason, let's just say you decided to take it off. You made $45. You're up. You took the trade off. Right? That's possible. Right? I mean, you get in the trade. You put on a hedge. You have a $25 risk. It has to move $10 for you to make much. So, it goes down 40 pips. So you made, $45 on the trade less 10. You made $35 on a $25 risk. And you close your FX. Well, this thing's at like max loss, right? You only have $10 risk on it. Do you need to close it? Do you need to close this spread? No. The market could go right on back up like this. You can end up shutting this thing down. Let's say you're trailing it, whatever. And maybe you close it down on a trail at 57.30 or something. And so you make $20 on that also, or $200 if you're doing 10 of them. So just because you close this trade doesn't mean you need to close the spread. So it depends on how much risk is left in that spread. If there's not really a lot of risk left in the spread, if there's not any risk left in the spread, leave the thing on. You could set it at break even. So maybe if the market goes back up, you could get out. Or, maybe if the market's going up, you decide, hey, I'm already in a long position. I'll just ride this long on up there and trail it, see if I can make, a little extra with it. So, again, you can be creative, which is the best part. I mean, first get down to the basic thing. But, once you've, exited your trade, look and see, is there risk left? If there's not, then don't just try to shut the thing down. Like, let it pull back, to break even, or maybe half, or, maybe ride the thing and trail it. If you have a long signal, especially. Okay? So that's really how they work. That's the magic. Like I said, it's not that hard. Difference between where I sell and I buy and what's my risk, and that's how far it has to go. So let's talk about a cheat. All right? Using the scanner. You can go in and you can look at the scanner and you can do all the math, which is pretty cool. I can go in on here and I can go, well, what is my risk? Because the scanner, the proximity, some people don't, realize this. The proximity is in underlying ticks. So if it says, 40 or 30 or whatever, and we're talking about negative proximity at this point in the game. Okay? If it says like negative 33, I have 33 ticks at risk. Okay, probably don't want to do that trade, but just going into an example for you. All right, so if it's a negative proximity on the sell side, or a positive proximity on the buy side, then that is my risk in the trade. Okay, so again, if I'm getting a negative proximity on the sell side or a positive proximity on the buy side, that is my risk in the trade. Okay? So I can go 33 ticks of risk, 43 ticks of risk. Like, really simple. You instantly know your risk on a hedge. If I sold this 29.6 and I bought this at 37.75, that basically comes out to, in quarter ticks right there. Okay? You got 29, like 39. So yeah, a little bit less than 40, right? So if you go 10 points, 4 ticks a point, 40 ticks. So a little bit less than, 40 ticks, like 7, ticks less than 40 ticks. So 33 ticks right there. All I have to do is look at that number. A negative when I'm selling or a positive when I'm buying tells me my risk on a hedge. If I'm buying this and selling that, like in ticks. Okay, now, if I was doing like touch brackets or master spreads, okay, then that could actually be like dollars. So, because they tick in 0.1 on S&P 500. So, on the US 500 on the spread. So if I bought a master spread, let's say I bought this one over here, and I sold this one over here, right? Then or maybe actually the master would be the one right above it. Here, let me erase that. All right, so if I bought this one, the way I know is because master is the widest spread. If I add those two numbers together, that's like 800 versus these are 400. So if I bought that master spread and sold this lower spread, my risk on the trade is $33. Well, that's cheaper than any spread that's available right now. Look at this. All these spreads, I mean, $80, $100, whatever. And this thing goes down to 20. Let's see here. Do another picture for you. Try to get the whole thing this time. There we go. If I buy this, if I want to go long, and I buy any of these spreads, I'm risking quite a bit right now. Okay, this is like pretty much with the whole day left on them. $84. But, this one's $382. But if I go in and I buy this for $26.38.2, and I sell this for $26.29.6, okay, then what do you think my risk is going to be? This feels like a little bit of a trick question, okay? So, well, it's going to be 33 ticks, right? Because you taught me that my risk is 33. Yes, but here's what I want you to remember, okay? Just trying to point out some little tips along the way. The underlying tick size is 0.25. It's not the same as like a spread. What does 0.25 equal in 33 ticks? Okay, let's just do 33 times 0.25. So 82.5 or $83. So it's about the same risk as of this moment to buy one spread as it is to hedge. Well, why would you do that? What would be the benefit of possibly doing this? On this spread, there isn't one. Okay? So you could go either way. You could buy the spread. Now, the one, advantage you could have is if it, let's say, goes up and you take profit. So here's the one edge. Okay, there's no edge like mathematically right there. But in strategy, there is. Because if it goes up and you take profit on the long, you're still in the short. And it could go down. Right? So, and then also, of course, you can add other spreads on. So there are ways to make it more advantageous. And like that's what I want you to look at is this the best contract? Is it not the best contract? And we'll go through a lot of examples. But to make it really simple, let's just, but I wanted to remind you that because if I didn't show you like that 33 times 0.25, then I was afraid some of you are going to think you had a $33 risk. And again, it's the difference between you buy and you sell. So it's just, and if you want to do the math, if you're like, well, I'm not sure, and what is that again, and I can't remember, you can literally go, okay, 2638.2 minus 2629.6. Okay, and that, divide that times 0.1 a tick, it's $86. Okay, so that's how you can get like right down to it if you don't remember that, hey, I just multiply that times 0.25 if I'm doing just spreads. But as far as like futures, risk is 33 ticks on that trade. Maybe that's too big for you. Now, what did I say? I don't know if you remember this. I said this earlier. You don't have to always put the spread on when you get in the contract. Maybe you buy the ES and it moves up and that spread becomes more favorable. Okay, because you can sell it at a higher price. And maybe you could end up selling it up at like 26.35 or 30, when you bought it 26.38. So you put that on just to, cover yourself in case something catastrophic happens, market flies against you, whatever. So, or new 2-hour spreads come up or 8-hour spreads or whatever come up. So there's a lot of things you can do. What I want you to know right now, what I want you to be confident in right now as of this point in the training is if you're selling a negative proximity is your risk when you're doing a hedge, okay? A positive proximity, if you're buying, is your risk when you're doing a hedge. Combining the two together. And then, so proximity becomes risk, right? We got that down. Proximity becomes risk. Now, what about risk? Well, now your risk becomes proximity. So as of expiration, now you could make money before this, okay? Obviously, because the market could move in your favor, premium's going slow. You could easily make money before that proximity or that risk is all eaten up. But, we're looking at, $104 there. So basically, it would have to move. Let's see, $104 is it ticks in 0.1, remember? So that's basically 10.4 points. So basically, have to move 10 points before it really overcame all the risk left in this spread. So you may not like that trade. I have to move 10 points. I'm risking 33. Personally, I'm not a big fan of putting that hedge on right now. But many times you will be in favor of it. Okay? So just look at them and see, is this a good idea? Is this not a good idea? Premium's really high right now. We had some big moves today. Okay? That's why it's so high up. But I just want you to see it. Okay? So remember, calculate this into underlying. Calculate your proximity into underlying tick size. Okay? And calculate your risk into spread tick size. And that lets you know, okay, I got to make back, $100 worth, which is in 0.1. Okay? US 500 ticking in 0.1, which if you click on this right here, it'll tell you it's 0.1 for the spreads. So I got to make, 10 points back before I'm really in the clear. Now, I'll start making money before that because, again, all that money is going to disappear just because the market moves. But that's my as of expiration point. Okay? So, again, you'll see often that you'll actually start making money before all that risk is gone. Okay? But sort of good to know that worst case scenario. And then, of course, it would cover you down to, the floor here because it could make it down to 2,600. Right? If you're going short, if you sell this spread. All right. So, again, look at your risk in the spread tick size. Look at your and that's going to be your proximity, how far it has to move. Look at your proximity on the negative side on sell and the positive side on buy. It's pretty easy. Negative sell, positive buy, and the underlying tick size. Okay? That's the cheating way to do it. The other way is just do the math. Okay, how much I'm buying it for? How much am I selling it for? What's the difference? What's the value in ticks? So you can also do it that way. Whichever way you prefer. I'm just showing you one cheat example. Another way is just do the math on a calculator. Okay? Or whatever. All right, and the last thing I want to go over with you, because I know this question has already popped up in some of your minds as I've been talking, is, well, what about when you got positive premium? I mean, Daryl, let me take another clean picture for you here. You said the difference where I buy and I sell. So, man, if I buy the underlying at 26.37 and I sell it at 26.47, then I have no risk. I'm actually locked in a $10 guaranteed profit. No. Okay? Remember when we talked about premium and all that stuff, and especially big premiums, we talked about how two things. One is they move slower. Okay? So when that thing starts moving against you, you're not going to see all that profit just hedge you. We're wanting a hedge. We're wanting a contract that's going to cover us. Okay? So it's going to start moving against you, and yeah, it could move against you 10 points as of expiration, but what if it moves against you 10 points as of now? Okay? Do you still want to be in that contract? Because I guarantee this thing is going to make you that much. Right? So it actually have to move quite a bit. And what did I say about making money? And this is the biggest piece that people aren't thinking when they see that positive premium. They're like, I can sell higher. Okay? And it's not that there's not any possibilities, but you're getting really complex if you go there. Okay? But here's the biggest thing you need to remember. Look at that. 323. So divide that by one. Got to make $30. Okay? Pretty much before you really are going to be looking at making anything while that thing's moving. Okay? Because you got to make all that money back. So to really be making money on your underlying, you got to make back all that money on the spreads. Okay? 30 points of movement. 32, I guess. And then, so you can sell higher. Well, sell higher is great as long as everything goes in your favor. Okay? But if it doesn't go in your favor, it's going to go against you. Your hedge isn't going to protect you that well. Okay? And it's just not going to work out as well. You're going a lot more complex. And Like I said, I'm not saying there's not any possibility here, and this is something I could cover in a premium collection course as an advanced way to do that. But as far as you wanting to do a hedge, that is not a good way to do a hedge, because the goal of a hedge is to lower your risk on a trade with maximum protection. Okay? To lower your risk on a trade with maximum protection. This doesn't give you maximum protection. It only gives you 77. And if your goal is to go long on ES, you don't want a contract that can require you to move 32 points before you start making money. So I'm not saying it's not possible. I'm saying it's not wise if your goal is to make money going long on the S&P 500. Okay? And it'll be fun to mix this stuff up and go over it with you. But right now, just keep it simple. All right? And just focus on the ones with more profit potential than risk potential as hedges. And there's a lot lower hedges than this. This is just, maximum possibility right here. Okay? All right. So I know that last piece was a lot. And some of you feel a little lost. If you got down the risk, how to calculate your risk, okay, whether it be with a calculator where you can just subtract the two, what's the value in ticks, or whether it be, hey, using the proximity and calculate that out, or, and what's your risk on the trade, calculate the difference between where they are, right, and proximity. What's your proximity? Well, simply your risk in ticks on the, underlying tick or spread ticks on the scanner or on any spread. If you don't have that down, go back and watch the first part of the video and then just skip this last part and come back to it when you want to dig a little bit deeper, okay? So I know I'm digging a little bit deeper here because I'm really wanting to go into some things. And I know these questions are popping up in your heads of those who have been through this with me before, especially, okay? And for those who haven't, just keep it simple, all right? Where you got negative proximity on the sell side, you got positive proximity on the buy side, that's your risk. How far does it have to move? Whatever the risk is in, spread tick size. So, 8.4 points or 10.4 points, okay? Depending upon which direction you're going. All right, I hope y'all picked up quite a bit from that. I hope I didn't lose too many of you in this last part, but if I did, like I said, just go back and watch the first part, first 20, 30 minutes of it, where I just go through the example piece by piece, okay? And then you can stay away from this part if you're getting all mixed up on it. All right. On to the next part of the course, ratios. And before we do that, I have one last piece, and this is what the Ultimate Hedge is about. This sort of drills home that point I gave you of, what's the purpose of this is to lower your risk and maximize your prop potential. One of my favorite quotes in one of the Rocky movies is, it's not how hard you get hit. It's how hard you can get hit, but still keep moving forward. Okay? So that's what the hedge is all about. It's about getting hit hard on a trade, but still being able to move forward because you hedged it off. And, again, always about moving forward, meaning moving in your direction, even if it comes against you really hard. And that's what hedging is about. So I hope you will learn a lot as we go through this series, but this is definitely a good way to start it off. Again, my name is Daryl Martin with ApexInvesting.com, and check out our site to learn more about the Ultimate Hedge and spreads and futures and forex.